So be very careful here. Don't just hear this or see headlines in the news and think, oh boy, I should probably go sell some assets, to recognize some capital gains at a, lower capital gains rate just in case this proposal goes into effect, because this is one where they are looking to put it into an effect before the end of this year.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm your host, Scott Searens, and in today's show, we're going to talk about the recent proposal that came out, the new American Families Tax Proposal. The Democrats on the House and Ways Committee released their new proposal on September 13th. Very different from probably what many expected, and changes to the original proposal. And again, just a proposal, but now will be debated by Congress and then finalized or potentially finalized in the weeks to come. So what I want to do is walk through some changes, proposed changes in this new tax proposal, things that they will be discussing, things that could potentially be finalized, ways that could impact your financial future from a tax standpoint or an estate planning standpoint. Now, most of the proposals were focused on taxpayers, or the people who will be impacted the most would be taxpayers that fall within that $400,000 to $500,000 income range or higher. However, there are some strategies that are being impacted or eliminated for taxpayers with incomes that fall below those amounts. So please follow along. There are things to be aware of. Some of these changes could change your taxes immediately, meaning in 2021. Some take impact in 2022, and then some would take effect over the next 10 years. Now, like I had mentioned before, these are not final, but I think it's really important to be prepared, because in the event that these do become final, you might have months, weeks, or just even days to make decisions in regards to you and your financial future. So follow along, or if you say, hey, I don't fall in those income, tax rates, or I don't have that much income coming in, you may still want to follow along to understand how the government is generating dollars to help pay for some of the different proposals and bills that they have out there. We're going to break this down into 4 different categories. The first category is changes to income tax rates and capital gains rates. The second category being changes to retirement planning, how you can save into retirement plans, and then changes to investment strategies. The third category being changes to required minimum distributions, focused on high income, those that have lots saved up into their IRAs and 401ks. And then our fourth category, I'm just going to call it estate planning changes and other miscellaneous changes. Again, all part of this proposed bill. Again, still not final, but important to be aware of, because as this now goes to Congress for debate, again, they could make changes to these proposals, but something similar could go into effect immediately or prior to the end of the year or the beginning of next year that could have an impact on your 2021, 2022 taxes. So it's good to be aware and to be mentally planning from a tax planning and financial planning standpoint. All right, with that, let's dive in. The first category that we're going to talk about are proposed changes to the income tax rates and capital gains rates. So first off, let's start here. One of the proposed changes is to make the top ordinary income tax rate 39.6%. Now, part of the Tax Cuts and Jobs Act, they reduce that top income tax rate to 37%. However, part of these proposed changes would permanently reinstall that 39.6% rate as the top ordinary income tax rate. This change, or proposed change, they are looking to start this in 2022. Now, what you might be thinking is, hey, never really fell into that bracket, right? And that could just be a 2.6% jump for those that fall into that bracket, which is a significant amount based upon how much they're making. However, they're looking to actually reduce the taxable income, or I'll say reduce the threshold of where this bracket would start. Meaning, if you are a single filer, right now the top bracket starts at $523,000 of income. However, with this proposed change, they're proposing now that this new top bracket starts at $400,000 of taxable income. Married filing jointly, that top bracket started at $628,000 of income. This new proposal would say that the top bracket for married filing jointly would start at $450,000 of taxable income. So for those making $400,000 or more, some folks here could actually be looking at a 4.6% bump in taxable income, right? Kind of if you're making somewhere between $400,000 and $630,000 of income, you're actually going to be looking at a 4.6% bump in taxable income for a portion of your income. So important to be aware of that as you look at your, if this goes into effect, it's important to be aware of that, especially when you're looking at things from a tax planning standpoint, a withholding standpoint, making sure that you can, continue to withhold enough for taxes so you don't have a big tax penalty at the end of the year. Another portion of this first category is they are looking to raise the top capital gains rate. So the new proposal is that the top capital gains rate would go from 20% to 25%. And again, changing the threshold. So this top capital gains rate of 25% would start at $400,000 for single filers and $450,000 for those married filing jointly. Now, be very aware. I don't want everybody to go out and be like, hey, just mentally, if this were to happen, right, I'm going to just go and, recognize some capital gains this year at a lower rate. This is one where, as part of the proposal, they are actually looking to put this into effect before the end of this year. So this would be something that would go into effect once the law is signed into order, or they could just pick a date at some point in time in 2021. So be very careful here. Don't just hear this or see headlines in the news and think, oh boy, I should probably go sell some assets, to recognize some capital gains at a lower capital gains rate, just in case this proposal goes into effect, because this is one where they are looking to put it into an effect before the end of this year. So good thing to be aware of there. All right. The next one is for those that might have an S-Corp. Now, I'm not going to get into the detail here, and I should have said from the beginning, a lot of what I am talking about here, I'm going to link to an article from kitsis.com. Again, it's an article from kitsis.com. You'll find it in the show notes, and I'll link to it. It's got some great detail in regards to all of these different proposals. The next one is, again, still staying in the category here of changes to income tax rates and capital gains rates, is for those that might own their own business. They might be a sole proprietor, anybody who is getting taxed at the S-Corporation status. So any S-Corporation owners, or if you're getting taxed at that S-Corporation status, one of the proposals is the application of the 3.8% net investment income tax to S-Corporation owners. Again, there's going to be thresholds in here of $400,000 for single filers and $500,000 for those filing jointly. And this one actually has a lot of detail into it. So I just want to hopefully trigger a thought in your brain that if you're an S-Corp owner, please go take a look at the article, walk through some of the different examples that they have here, and see if this 3.8% surtax that they are talking about would apply to you or not. The Next change, and I will tell you this is to the ultra high income taxpayers, those with a modified adjusted gross income that exceeds $5 million. What they're proposing is basically a 3% rate that would apply to individual or those filing jointly with a modified adjusted gross income to the extent that it exceeds $5 million. One additional note there, though, is that I caught as reading through the article is this 3% surcharge would also apply to trust income in excess of $100,000. So be aware of these different changes to income tax rates, capital gains rates. Understand where you're at today. Now, think about taxable income. Taxable income doesn't just mean employment income. It doesn't just mean what you have coming in from your job. That taxable income could also mean what you have coming in from required minimum distributions, from rental income. So all of these, you really want to sit down, speak with your financial advisor, your tax consultant, and understand what are the best thoughts, not actions yet, right? These are just proposals, but what are the best thoughts to start having in place just in case these do go into effect. That way, then you know what actions that you might need to take as well. Okay, let's jump into our second category. The second category here is retirement planning changes or investment strategy changes. The first, which is an interesting change here, is the potential elimination of what is very widely known as the backdoor Roth IRA strategy or the mega backdoor Roth IRA strategy. Basically, what they're eliminating or prohibiting would be converting after-tax dollars. So if you made an after-tax contribution to your IRA, right now you could convert that over into a Roth. So this has been a way that higher income earners, again, this doesn't apply just to the people that are making $400,000 or more or taxable income of $400,000 or more. This actually is a strategy that could be used by anyone. And so what it is it's prohibiting those conversions of those after-tax IRA contributions. It's prohibiting you to convert those over into a Roth IRA. That proposal is proposed to change beginning in 2022. Next, they are also looking to eliminate or prohibit conversions for high-income taxpayers. Now, this is a proposal that does not take place right away. This is one that actually they are saying this won't take place until 2032. But what it would do is prohibit those with taxable income in excess of $400,000 for single filers, $450,000 for joint filers. It would prohibit them from doing Roth conversions, converting those IRA and 401k dollars into Roth IRAs. The next is the proposal to prohibit IRA contributions. Now, this one is for those that are higher income and already have accounts, IRA accounts with or in excess of $10 million. So if you are making $400,000 as a single filer, again, taxable income $450,000 as a joint filer, and your total retirement accounts are worth $10 million or more, you would be prohibited from making IRA contributions. The last in this category is basically an investment strategy change. And the proposal is a change to the wash sale rule. Wash sale rule basically says that if you have an asset or security, this is why they're changing it. It's not just saying asset. It says if you have a security, meaning you have, just make an example up, Apple stock, and Apple stock dropped in price and you decided to sell it, you have to wait 30 days before you can buy that Apple stock again. Otherwise, you're not able to use that loss as to offset gains in your taxes. Now, the one thing that they recognize is this wash sale rule did not include cryptocurrencies, commodities, and other foreign currencies. So one of the things that's part of the proposals is that beginning in 2022, the wash sale rule would then include those assets that I just mentioned, cryptocurrencies, commodities, and foreign currencies. The next change here is in regards to required minimum distributions, but it's for those taxpayers with, again, a high taxable income, but also with a large-sized retirement account. And when I say large-sized retirement accounts, I'm talking about retirement accounts where your total IRA values, IRAs, 401ks, Roths, etc., are in excess of $10 million. So for those that have, again, taxable income for a single filer, $400,000 or more, joint filer, $450,000 or more, and then your total retirement accounts are worth more than $10 million, you will be subject to RMDs, required minimum distributions, for that year. And here's a really interesting caveat to this. When they say for that year, it doesn't mean for that year age 72 or above. It means for that year. So, for example, you could be age 40, age 45, age 50, age 60. Age doesn't matter here. What matters is your, again, adjusted taxable income thresholds, as well as how much is in your retirement accounts. Now, if you are before that age 59 and a half, part of this proposal is that there wouldn't be an early distribution penalty. Okay, so let's just say you did meet all of that criteria. What the proposal is here is that you would have to take in required minimum distribution equal to 50% of the total retirement account dollars in excess of $10 million and less than $20 million, plus 100% of the total amount in retirement accounts in excess of $20 million. Now, the other interesting proposal here is that there would kind of be an order of operations. And what that order of operations would be is that if you did have money in a Roth IRA, the Roth would be the first portion where you would need to grab your withdrawals from. And I know what you're thinking. Wait a second, I thought Roth IRAs, there were no required minimum distributions. And you're correct. Part of current law is there's no required minimum distributions for Roth IRAs. Now be very careful. If you have a Roth 401k, you could have required minimum distributions. A really important point of why you want to roll your Roth 401k into a Roth IRA. But with this proposed change, if this did go into effect, your Roth IRA would be the first that you would have to use to help satisfy these new required minimum distributions. So, again, higher income, and you've got $10 million or more saved in all of your retirement accounts. That's Roth, regular 401k, Roth 401k, etc. Good to know and to pay attention to, as you could be subject to required minimum distributions each and every year, no matter what age you are at. Okay, our final category here just kind of lumps in all of the other proposals that are part of this bill. So the first is a reduction in the unified credit amount for estate and gift taxes. With the passing of the Tax Cuts and Jobs Act, what that did is it gave a gift tax exemption of over $10 million at that point in time. Now it's up to over $11 million per person. And what this proposal does is it reduces that back to $5 million, and that to be inflation adjusted starting in 2022. So one thing is if you did have an estate, or if you have an estate that is, $5 million or more, and you're a single, or if you're a couple and you had an estate that's $10 million or more, something to be very aware of here, that if this passes, it could, get rid of that exemption. So the current exemption was supposed to expire in 2025. You might have been looking at it saying, hey, I've got another 4 years to put planning in place. This could cut that time frame short. Another item here is elimination, or it really impacts and eliminates the discounts used that might have been used through family limited partnerships. So all of these, I'm really going to say, hey, stop, you really need to talk to your estate planning attorney, your tax consultant, as well as your financial advisor. And I will, again, push you to the show notes and click on the link to the article to get more detail in regards to these. I just wanted to talk about these so that way you know that there are proposals and thoughts that are out there in regards to some of these items. Another estate planning item to be aware of is that I'll call it the elimination of the defective grantor trust. Again, see the article for all the details in regards to that. Another proposal, and I just kind of lumped it in here to this last category, is they do propose to expand the child tax credit through 2025. And again, proposing that they provide advance monthly payments extending into 2022, and then beginning in 2023, the child tax credit, instead of an annual, would transition into a monthly child tax credit. Now, all of this is based on your taxable income. So just because, again, they propose to make these advance monthly payments, you should really understand where your taxable income sits and if you actually fall into getting the child tax credit. Because if not, then it's something that you may need to repay, when your taxes come due. So really understand that, work with your tax consultant and see, how and what is best for you and your situation. Folks, I really hope that you found this overview to be helpful. It's mainly just to put these thoughts now in your minds. Like I said, it's just a proposal. It needs to go through Congress to be discussed. More changes could be made to the proposal. For those of you that have been, following this from the beginning, these are some big changes from the initial proposal. So what's important, though, is to keep this in mind. Work with your financial advisor, work with your tax consultant, work with your estate planning attorney to have the right thoughts in mind and have the right strategies prepared in the event that these do go into effect and are signed into law. We'll continue to keep you updated in regards to more or future proposals as we see this go through Congress and as we see that it might get closer and closer going into effect. I hope that you found this to be of value and benefit, and if so, subscribe to the podcast or check us out at lifemoneyshow.com. Again, that's lifemoneyshow.com, where we've got podcasts, blogs, videos to help you and your financial future. Hey, I look forward to our next conversation, to helping you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.